Good afternoon. My name is Kendy Alvarez, and I am a loan originator here with Collab Lending. Very excited to talk to you all today about preparing for your pre-approval. Oh, you want a couple pages too far real quick. Sorry about that. And so I have been a mortgage loan originator for about 10 years now, and I really look at the work that we do as a tool for community and economic development. I primarily like working with first-time home buyers, especially people who, you know, aren't really sure where to start, or what this process will look like. And so hopefully this takes some of that anonymity out of a process that can seem overwhelming for you all. So, what is a mortgage pre-approval? Well, to start off with, to be able to purchase a house, you have to get a mortgage. And the first step in that is making sure that you're qualified. What that means for us in your mortgage pre-approval is that it is really a snapshot of your financial profile. It takes about 60 days of history in your finances and captures that. And that's what we look at to figure out your things like your debt to income, your payment ratio, that sort of thing. And so it's really important that in this process that you start with a pre-approval, understanding where you are in your stage of qualification before you move forward. And so one of the really important ways that this streamlines the home buying process is that when we have a competitive shopping market, it really means that you're able to put the best possible offer forward. A pre-approval isn't just, oh, how much can I qualify for and how much can I afford? But it's really, how can I structure my financing so that when I put an offer together, I'm making sure that I'm making the strongest possible offer that I can make when I'm looking to purchase a home, make me more likely to have my offer received so that you're not going back and forth on multiple homes over a longer period of time. And so the advantages of being pre-approved, yes, initially it's talking about, making your strong offer, but other than that, it's also looking at what are all of the ways that you would be able to make changes to your financial profile to strengthen your pre-approval over time. It could be simply things like, I've had a part-time job for a year and a half, but in 6 months, I'm going to have that part-time income for over 2 years. And now I'll be able to use that in addition to my full-time income. It could be something along the lines of having some negative items on your credit report fall off after a period of time, and that improves your score. Or even paying down some debt that will allow you to improve your credit score and improve the amount that you're able to qualify for. So the first really important thing is understanding your credit. It's not just your credit score, but what's in your credit profile. And so if you haven't already, in this process, had a credit report pulled, there are lots of opportunities for you to pull your own credit report out there, get a copy of that, and go through and make sure that the information listed in your credit profile is accurate. Make sure that it's all up to date and be sure that you understand what's listed in there. This is the time prior to being pre-approved that you can have things that aren't supposed to be there removed. You can make sure that cards that are listed on there are listed accurately if you have accounts that have closed, accounts that have paid off, things like that. You want to make sure that you take the time and update this information so that when you do have your score pulled by a report pulled by a lender, the information they're looking at is the most accurate. And then they're able to tell you, in addition, if there's anything else that you can do to improve it. One of the biggest recommendations across the board that we make is specifically dealing with the amount of credit that you're using at one period in time. Knowing that you can, if you have, a credit card that you're always less than 30% of the available balance at all times, that is the optimal amount for you to maximize your credit score. If you can't do that, the other targets tend to be less than 50% or less than 75%. If you're someone who uses your credit card and then tends to pay it off, what you want to make sure that you do is that it is paid off prior to the next billing cycle, or else what's reflected on your credit report is not necessarily that it's paid to zero. And so making those slight adjustments in how and when you might pay down your debt can really have an impact on improving your score. Another thing that people often don't realize is if you're co-signing with anyone else, all of that information is also on your credit report. So you do want to make sure that if you have any other debt with someone else, that you understand how that's going to impact your score, and make sure that prior to your pre-approval, that you get all of those things aligned and you make sure that they're making on-time payments and things like that. The next important part of the pre-approval is gathering all of your important financial documents. Now, we take essentially a 60-day snapshot of your financial profile, but we need documents like your bank statements and tax returns and your W-2s, because we do look at a 2-year employment history. You know, when it comes to mortgage financing, everything is centered around, risk. And so how risky you are as a borrower is going to limit the mortgage options that are available to you. And so the better secure that you are as a borrower, the more financial possibilities that lay out for you. And so when you're looking at your financial portfolio, you want to say, okay, what are the ways in which I can prepare myself to be less risky? And things like that. It's stable income over a 2-year period of time. If you're someone who, you've been making some career changes, and in those changes, from the outside, it seems rather sporadic. Be prepared to explain what that trajectory looks like. Why did you jump from this job to this job after 6 months? Did you stay at this other one for a period of time? And be able to explain what, salary improvements, if you, went from being part-time to full-time, if you got added benefits, how does that all change your financial profile? And does it make you more secure of a borrower now than before? I think that one of the interesting things that happened recently with the pandemic is that we had a lot of people who were working full-time that left that and realized that they could, increase their income, not necessarily working a full-time W-2'd job, as an employee. And so they became self-employed, or they started doing like the gig economy. And one of the things on, the financial end for mortgages is that makes you seem more risky as a borrower. You may be making twice as much. And, there's a certain logic that goes, well, wait a minute, that doesn't make sense. And to a certain extent, you're right. But it's about stability. And there is a mindset that, a W-2 employee is more stable than somebody who's 1099 or self-employed. And so when you're looking at, making a financial purchase as large as a home, you want to make sure that you have all of that information, and that if you have made changes, that you talk to your mortgage originator and have an understanding of how that can impact your financing during the pre-approval process rather than after. Now, as we've talked about income, one of the really big parts about mortgage pre-approval is calculating your debt to income ratio. What that means is we take the amount of debt that you pay monthly and the amount of gross income that you make monthly, and that gives us a ratio. Ideally, you want to be where your housing debt to income ratio is less than 30% of your income. So you don't want to pay more than 30% of your income towards your fixed housing costs. And that's kind of where you want the cap to be. There are a lot of loan options that fluctuate outside of that limit. But to be safe, I would say that's where you want to be to start off with. So if if you want to think about, okay, how much home can I afford without, just a rough estimate, one of the best ways to say, okay, what's my gross monthly income? Take 30% of that, and that's where you should expect to be with your principal and interest, taxes, and insurances. How your debt to income ratio impacts your pre-approval is that all of the loans are not cookie cutter. It's not like, if you're within 30%, you're guaranteed to be approved without taking into other factors. The debt to income ratio is a factor, and there are certain loans that have very strict guidelines with regards to where your debt to income ratio can be. And so the automated underwriting systems use that in their calculations in the algorithm to determine whether or not you'd be approved. Now, those automated underwriting systems, throwing out some more interesting things, that's something that exists. AI has been around in the mortgage industry for quite some time. And these automated underwriting systems take all of the information that you're using to determine whether or not a mortgage will be approved. And they throw all of these different numbers in there and then calculate, layers of risk for approval or for, manual underwriting, which is an option, which means that it needs to be reviewed by someone else to double check, because it doesn't necessarily fit within the parameters for the automated underwriting system. And so that's one of those things can be the debt to income ratio. Say your debt to income ratio is at 45 and the automated underwriting system really wants you to be around 42. Well, you might get referred to a manual underwrite, and so that somebody else can look at it and figure out, are there errors in the input of the information, or is there additional compensating factors that would allow this to be, something that could be approved as opposed to denied? Some of those compensating factors could be, you've got a bonus and you're guaranteed to receive your bonus every year, but you just started your job 18 months ago, so you don't have 2 years of that bonus history. There are those nuances that exist that would require an extra set of eyes. I think that it's important that whether or not you're looking for a mortgage, it's important to have a realistic budget. How much is it that you can feasibly afford to spend on a monthly basis towards your housing costs? And I think that it's really important not to think, well, what's my max? Because there are always going to be additional costs. And you don't want to put yourself in a position where you found your dream house, you're really excited, but now you're strapped and you can't really afford to live in your house and to enjoy it. The next part of the pre-approval process is saving for your down payment and closing costs. There are a range of loan options available from no down payment to, say you've got a bunch of money saved and you've got a large down payment in your closing costs. It's important in this particular market right now where we do see less inventory and a certain level of competition that you have some money saved that you have to work with within the system. There are loans that, conventional loans with 1 or 3 or 5% down. And there's no, one size fits all solution here, but it is important to have some savings. And I think that when it comes to looking at, how much you should have, if you're expecting that 30% of your gross income goes towards your housing, then even if that's not what you're currently paying for your housing costs, you should be setting that aside so that that extra is money that you're saving. It's also taking a real assessment of your finances, budgeting, looking at where your money is going and figure out where you might be able to save some money. There are also some amazing down payment assistance programs out there. See if there are any that you will qualify for that would be able to help and assist. But it's also really, I think going back to basics and saying, all right, this is how much I have and this is how much I can save. That's really important. Then it comes to shopping for your mortgage. There are a variety of loans out there and many different types of lenders. One of the benefits of working with collab lending is that we're a mortgage broker. So we do the shopping for you. We become the one-stop shop for you to be able to shop around for your mortgage. You can come to us. We get an understanding of, your financial profile, your financial picture, what it is that you're looking for in your financing, and then we can shop around through the lenders that we work with to say, okay, these are the types of loans that would work best for what your goals are financially, and then from there match you up. We take into account, what the different lenders' interest rates, fees, and costs are, but it's also understanding the types of loans that lenders prefer and which ones work best for different types of lenders so that we understand, I recently had a client with an investment property, and somehow we were able to close in 17 business days with a delay because of the appraisal. How did that happen? My buyer was prepared for 6 months prior to finding their home. And so the timing was just right that they had all of their documentation, everything was in place. They were, not making a whole lot of changes financially leading up to, so that at the moment in which they found a property, applied for their mortgage, we were able to close in 17 business days. And that included Thanksgiving, Christmas, oh no, sorry, it was Christmas, New Year's, and President's Day. So three holidays Martin Luther King Day, three holidays in the mix of that. And so, it seems like, oh yeah, this is great. I'd like to be able to take the credit, but the reality is that I had a buyer that was very prepared for the process. And so it all comes down to making sure that you are pre-approved. The pre-approval process requires that you, provide us with some basic financial information, documents. And so it's pay stubs, bank statements, tax returns. Don't be surprised if after you provide those, you get asked for additional documentation. Oftentimes, there are more questions than answers at the onset. And that's good because if we ask the questions up front, it makes the rest of the process that much easier. And so I want to set the expectation for borrowers that it's not the kind of thing where it's like, oh yeah, fill out this short form online and I can get you pre-approved. I mean, there are places where that can happen, but that kind of laissez-faire kind of attitude does not work when it comes to really preparing you for what the mortgage financing process is going to be like. What do you do after you have a pre-approval? Well, the goal is to make sure that your financial picture remains the same from the moment that you're pre-approved until it's time to apply, all the way through closing. You don't really want to make a ton of changes. And if there are any changes, one of the first people you're going to want to call is your mortgage banker. You're going to want to call me and say, hey, Kendy, I got this amazing job offer. It's going to pay me, $3,000 more a year, and I've got an even better benefits package, but I lose my commission income. Okay, let's look at what that looks like. Let's talk about how that, works into your pre-approval. What does that change? So then we can decide, is that something that makes sense during the mortgage process, or is it something that you can defer until after you've found a house and closed? Common mistakes that many people avoid, that you should avoid, that many people fall into, making changes to their credit profile, either adding debt, taking out new accounts. Sometimes you're like, oh, well, I'm getting ready to buy a house. So before I do that, maybe I should trade in my car and upgrade. And you go from, a $200 car payment to a $500 car payment. That's an extra $300 a month in debt. That can really throw off your mortgage pre-approval. And so you want to make sure that you aren't doing anything that would change your financial profile in any particular way. And if you do have things coming up, whether it's 3 months, 6 months, 12 months down the line, have that conversation with your mortgage broker so that you can figure out how to navigate through that. If you have any questions, feel free to connect with me, Kendy at Collab Lending. That's literally my email address as well. Um, you can reach me on social media as well as via phone. Thank you so much for joining me today. And let me know if you guys have any questions.